And now they're blaming the government. They're blaming everyone else. They're not blaming any part of this on themselves. Well, yes, we had greedy lenders. We had lenders that were willing to go along with this when they never should have. But we also had willing borrowers who went out, bought these houses where they could have known better or should have known better, or worse yet, lied about the amount of money that they were making to get the house they were getting. There's plenty of blame to go along to everywhere.
Mm-hmm. You know, Mish, I'm sorry. I was just going to say, Mish, I worked with a lot of young people in the military, new officers, and it always amazed me that they lived not in the way that they bought what they could pay for and then slowly accumulate over time, but they would find out everything they could buy, whether it be a new Corvette or these other vehicles, and they would make sure, that all the payments they had equaled exactly what they brought in for the month. So they were just trying to get their payments to be 100% of their income, which they never did own anything. Now it seems like it's gone to the next step where people buy things even with the possible knowledge that their payments are greater than what they have coming in, or they get something at an introductory low rate on an ARM, knowing absolutely sure that if it goes up 1% or 2%, there's no way they can make it, then have totally decoupled from reality.
Oh, yes, and the same thing, that's an interesting point, but the same thing is happening with credit cards. People are buying things that they know they can't afford. They know that they can't pay the bill. But as long as the credit card companies are willing to extend them credit, well, they're willing to do it. And eventually as well, if I can't pay it off, they'll just go bankrupt. Or if they can't pay off their house, they'll walk away from their homes. Now, actually, I don't have a problem with people walking away from the home. Certainly, someone that's in trouble, lost their job or whatever, has every right to do that. And the worst thing is we see the industry, pressuring these people, don't do it, don't walk away from their home. Well, it was the same industry that pressured these people to buy these houses in the first place. Right. As I said, both sides were guilty, but you can't be selective then about trying to bail out the banks then at the expense of the consumer when both sides were guilty. I want to go back to the beginning, though, because we talked about some things that I was right on, and certainly I was right about where interest rates were heading. I was right about housing. I was right on the market top in the stock market. But I don't want people to think that I'm a genius. I've certainly been wrong about a number of things, and one of the things that I was wrong on, I did not think that oil would get to $147 a barrel, which it did.
But it didn't stay. It didn't stay there, though.
It didn't stay there. Absolutely not. And there was certainly a lot of speculation going on in the oil markets. These things always run to extremes. The oil ran to extremes. The housing market ran to extremes. The stock market and banks ran to extremes. So it's real difficult to call the top on these things. But I could see that the U.S. was slowing. I knew that Europe would slow. I knew that the United K and Canada would slow. Great Britain would slow, and they did. Meanwhile, while 3/4 of the world is slowing, the price of oil is rising. Well, it's started to correct now in a big time, and we're seeing that now. I hope it flows through at the pump. But people look at this. This is the lie. Be prepared for the next lie from Wall Street, because this is what it'll be, Dr. Fusion. Oil prices are coming down. This is good for the economy. No, right. Oil prices are coming down because the entire world economy is slowing. In the U.S., in the UK, in Japan, in Canada, in Spain, in Ireland. All of those countries are slowing remarkably. That's less demand for oil. So that's good that the price of oil is dropping. But if people look at the reason as to why it's dropping, it's not such a great thing, especially for the stock market.
Okay. Now, is that an indication of deflation because we have this situation where no one ever thought the demand for oil would ever start going down. I mean, we just have a more and more voracious appetite. But the fact is that there's less and less money for people to go around. Their staples are going up. We have localized price increases on requirements like food and other things. So even what we consider almost essentials like oil, people have found all sorts of ways to cut back because of this overall deflationary impact. Is that a good indicator of the deflation?
I wouldn't say it's a good indicator of that. But let's step back a moment. We need to, before we can discuss inflation and deflation, we need to have a sound definition of them. Inflation, to an Austrian economist, is an increase in money supply and credit. Some just say an increase in money supply. The deflation is the opposite, a contraction in money supply and credit.
Now, how does that differ from the standard one that you see out there nowadays? It seems like they use it mostly to talk about prices.
Price increases.
Oh, absolutely, and it's on purpose. It's purpose. Actually, the definition that I gave you is from the Merriam-Webster Dictionary in 1957. So it wasn't that long ago that people understood what money supply was. But just as we've seen manipulation with changing the definition of the basket of goods and services in the CPI, they've actually changed the definition of unemployment over the years, excluding all of these various things that we just talked about. So now it's 5.5%, but that doesn't compare to the same 5.5% that we saw even as much as 10, 15 years ago. They've changed the definition of what inflation and deflation are, and it's on purpose. So if we talk about prices, then no one's looking at the government printing money, more money every year than it takes in on taxes. That's what inflation is. It's spending more money than you take in, and just printing the money to do it. That cheapens the value of the dollar. That's what's going on. But on top of that, we have something called fractional reserve lending. It's kind of complicated, so we won't go into it here. But let's just say banks can borrow money into existence, lend it out. This is what happened in the housing market. The Fannie Mae, Freddie Mac, someone wanted to buy a house, they just gave them a loan. The money wasn't really there. It's just debt on the books of Fannie Mae and Freddie Mac. That debt cannot be paid back. Now we're in contraction. Now this is why housing is sinking. We're in debt contraction. Debts are being written off. There are bankruptcies. This is why Merrill Lynch and Citigroup, all these financial institutions, Washington Mutual, all these bank shares are trading at lows. They've got more debt on the books than can be paid back. Debt that can't be paid back will be defaulted on. So, yet, you see the reports in the media. Oh, the price of oil went up, or the price of corn went up, or gasoline's $4 out. That's inflation. No, that's rising prices. The definition changed. The definition changed on purpose to allow governments to spend more money than they take in. But it puts when it's called inflation, it puts an expectation in people's minds. Oh, Mish, inflation's going up, so interest rates are going to rise. And I said, no, this is another thing that I got right big time. No, interest rates aren't going to rise. And certainly Bernanke has now slashed interest rates all the way from 5.25% all the way down to 2%. Someone that looked at the price of gasoline while that was going on just wouldn't be able to make heads or tails out of it. My gosh, the price of food's going up, the price of gasoline's going up, the price of medical services is going up, but the price of homes is crashing, and the price of credit on the books is plunging, and corporations are scrambling like mad trying to raise capital. That's what deflation is. So someone that's looking at this from a credit standpoint knew that Bernanke was going to be cutting interest rates in yet another attempt to bail out the banks, just as we talked about that Greenspan did. but he can get away with it because this credit crunch is real.
Now, Mish, can I ask to make sure I understand you correct? The fact that they changed the definition to something different seems to me to imply, unless you said this and I didn't grasp it, seems to imply that they did that to be able to to try not to allow the public to see that they're largely the ones who cause the inflation or deflation. Because if it's related to money supply, they are the ones we should look at to blame for it. Whereas when they make it the price increase or decrease, we can look at commodities or other third parties.
Yes.
But really, it's them. It's a definition just to take away their own blame.
That's
as the ones
downright.
That's
downright conspiratorial.
Absolutely, this is done to take away their own blame, and this is why you never see Bernanke. And you never heard Greenspan talk about what they were doing to the dollar, that they were just printing these things, and the government was printing these dollars, buying up, whatever it needed to do to finance the war in Iraq, among all things. And that is one of the reasons why oil prices were soaring. But again, once you hit the point where consumers are no longer able or willing to borrow, and banks are unable or unwilling to lend, that is when you have deflation. That is when things plunge. That is when the prices of homes plunge. That is when the prices of automobiles plunge. That is when the prices of assets like the stock market plunges. But yet, through the myopic eyes of the Fed, it's still focused on the price of oil and talking about the price of oil. Either they're being deceitful or they don't even understand themselves how the economy works. Because it was clear to me that interest rates were that the Fed fund rate was going to crash. Meanwhile, other interest rates are rising. What interest rates are rising? The interest rate on your house, someone getting a new mortgage is rising. Why? Because of default risk. Again, this is the opposite of what we saw just a few years ago. Banks were willing to lend money to anyone on the most ridiculous of all terms. Now you have to not only are interest rates higher, but you've got to put down 20% on that, or you can't get a loan.
Hey, Mish,
so we've got a tightening of credit across the board. And
Mish, let me ask you this, following this line of thought, see if I'm thinking this correct. If that's the case, and if businesses, including banks, are desperate to get their hands on capital, how come they aren't raising the rates that they pay consumers for the money that consumers loan them when they put it in their banks for them to reinvest?
Oh my gosh, they are. And to the point of it being a moral hazard.
So you're actually seeing, you think there's pretty notable returns that they're giving now to consumers?
I didn't say they're notable returns, but they're notable spreads. That's how you have to look at it.
Okay.
The Fed fund rates is 2%. The interest on 1-year treasuries is like 1.5%. Banks are paying 4% on savings accounts. That's an enormous spread. For them to be that desperate to raise money from consumers when they can borrow from the Fed at 2%, yet they're raising money on savings accounts and CDs at 4%. So it's not like that 4 is such a great number, and that's the thing that has people confused. Well, they're not paying me anything. Well, yes, they are. They're desperate for money. They're desperate to raise money. And there's a moral hazard to that because the banks that are offering the highest rates on CDs, the banks that are offering 4% are the weakest banks. Why do they need to raise money? Because their loans are going bad. They don't have capital. They've made these investments that are going south. So
why don't they get more? Why don't they get more from the Fed at 2% then? What's their limit on getting?
Some of the smaller regional banks can't. This is the big ones can borrow from the Fed at that.
All right.
So these small banks are out there scrambling. The weak banks paying 4%. And guess who that hurt? First off, it does two things. It keeps the Ponzi scheme going.
Right.
Those banks that are invested in, saying, the building of the condo towers in Florida, it keeps funding these projects that have no business being funded. And the second thing it does is it deprives banks that are doing sound lending practices of capital. So we have a flow of money from the strong banks to the weak banks, because the weak banks are paying 4% interest rates, while those that are engaging in reasonably sound lending practices might only be paying 2%. That's the moral hazard, actually, of FDIC insurance, which I believe should be eliminated.